which is a direct cost. That means you can apportion the cost, distribute the cost over the number of the units produced or sold. So different kind of the material cost that comes under that cost of goods sold. Then the labor cost, the labor who are working at the factory level, that is the cost of goods sold. Okay, and also the overhead cost, whatever overhead, the supervision the cost at the factory level, then the machineries used, all this comes under the. But I mean, as I said, machinery is an asset, that is not a cost, but the maintenance cost of that machinery, that is, and the factory level, whatever electricity you are using at factory level, all of these are coming under your cost of goods sold. Okay, those are the overhead cost. Then comes, after your operating profit, then comes the interest. So what is interest cost? So before interest cost, whatever we have discussed two types. One is the direct cost, or which is a product cost, and one is operating cost, which are indirect cost. It cannot be allocated to the number of units produced or sold. Whatever may be the production level, this cost you need to bear. That is the administrative cost, and these are periodic in nature. These are more fixed in nature because it does not vary with the number of units. So, but both of these are, both of these kind of costs are dealing with your operations, your day-to-day running of the business. Next comes interest. Now, interest, you may have this cost, you may not have. If you have debt in your capital structure, then you need to bear the interest. If you do not have, you need not to bear the interest. So interest has a direct relation with whom? Interest is related to your finance. Okay, the capital structure. So interest is not your operating cost. Interest is the finance cost. And extraordinary items. What are extraordinary items? As we discussed yesterday, we discussed some extraordinary items. What are those? Can you just, give me example? We discussed only yesterday. Extraordinary items. Maybe I have not named them as extraordinary, but they are not our operating costs that I have mentioned. So what are those costs? Extraordinary. Extraordinary means which is not ordinary, which does not occur in the ordinary course of business. Sometimes we bear those kind of costs. What are those? Any idea? Yes, Rayesh?
Ma'am, some durable equipment.
Yes, durable equipment what?
Ma'am, any equipment like which we don't use, like we don't trade it on a regular basis, that can be extraordinary item.
Okay, Saurabh, what you want to say? You
Ma'am,
want to say?
extraordinary is like some de-recognition of long-lived asset or sale of long-lived asset, which we do
Yeah,
not do
so I mean,
regularly.
so for example, I mean, when I say that loss of, you remember the loss and gains and losses of selling of your assets?
Yes, ma'am, gain and loss of some equipment
Yesterday we
or
were discussing. Huh?
yes, ma'am.
Yeah, so I mean, it is not I'm that saying that it is expense. We are saying that it is loss. But my point is, this is that extraordinary. That means, I mean, we do not incur this kind of cost on a regular basis, right? So these are kind of, extraordinary items. So we can have extraordinary gain also, we can have extraordinary loss also. Okay, so if you go and search for the extraordinary items, you will see that extraordinary items you can search, and you will find extraordinary as well gains or losses in a company's financial statements that are infrequent and unusual. Okay. So those are the extraordinary expenses, and then comes your last. Then after deducting those interest extraordinary items, then we get the profit before tax or earnings before tax. So why this is the way that we present? Why not to club everything? Just like expense, why there is an cost of goods sold and then operating profit and then profit before tax and then profit after tax? Why so? Because um, gross profit tells us how much efficient we are in controlling our direct cost, and how much we can build on the gross profit, gross margin. I mean, regarding the sales, regarding the cost, we can take decision. And operating profit is how we can efficiently manage our administrative expenses. Then what is the operating and what is non-operating? So for example, you have a very low operating, you have a very good not very good, I mean your operating profit is very good, but then you find that the net profit is very low, net profit margin. So generally what we look at, we look at the net profit and we think that what is the profitability position of the company, how the company is doing profitability wise. So net profit we look at, right? So net profit is not very good. So you are deciding that, okay, the company is not performing well. No. So you need to see the operating profit, because net profit is an outcome of not only the operating profit, but it also that the interest cost, the finance cost has a huge impact on the net profit. The extraordinary items has a huge impact on the net profit, right? So that means if it is a gain, where from it is coming, and if it is a loss, where for which the company is making loss. You may find that the operation wise he is doing good, but maybe since there is a huge amount of debt in the capital structure, so that's why the company needs to bear a huge amount of interest, and that's why the net profit is so. There is nothing, there is the problem is not with the company's operation, it is because of their debt level that their net profit is low. So this connection you can make if you just go and see the breakups of the profit. That is very important, how the company is doing. That only you can know if you just look at the numbers, gross margin, operating, every kind of profit has different significance. Or say for example, if we talk about the gross profit, how we can improve our gross profit, as we were discussing yesterday. Okay, either you need to increase your revenue or you need to decrease your cost. Now, how can you decrease your cost? I mean, can you go to the a better supplier who can give you materials at a lower cost? Can you, or can you go to and then you see the problems may lie many places. Can you go to maybe the problem is not in the revenue, but the pricing. So if you change the, not the volume of the your sales, but it may be a pricing. So if there is a 100% 100 rupees your 100 rupees your sales price and 90 rupees is your cost, then you need to see that if you change your price by 1%, say you make it 100 rupees and you change your cost price by 1%, then how much is the percentage of profit you are gaining by changing your price? Can you afford to have that? By changing your price, are you going to lose the volume of your sales? So this way you need to make the decisions. And then can you go to some there may be the problem of, even if there is a by reducing the price, can you increase the volume? Then are you targeting the right customer? Are you able to negotiate with your customers so that they can reduce their conversion time? You can reduce your conversion time from the receivables to collection. Can you go to a supplier who can give you materials at a discount? So these are the things you need to consider when we talk about the gross profit, all the sales related decision and the cost related cost of goods sold related decision. And in case of operating expenses, I already told you what are the administrative expenses. So can you save some money by not renting a big office space? Can you make it, can you, ask your employees to work from home? Is it going to save your administrative cost? I mean, these are the different kinds of decisions and without any knowledge of where is the problem. Maybe your gross margin is very good, but it is the operating expenses which is eating up your gross margins. So where is the problem? You need to see the breakup, and then only you can decide that the company, I mean, whether it is doing good or not. Maybe the marketing expense is very high. Maybe the R&D expense is very high. You have not apportioned. Maybe the consultancy fees are very high you are giving. So you need to check somewhere, right? And then comes the income tax, which you do not have any control. So that's why it does not depend on your decision also. Income tax means, I mean, whatever may be your profit before tax, you need to give tax on that, right? So you cannot, do anything about these income tax expenses. So when we do the profitability analysis, it is not only about net profit, it is also about your profit before tax, which talks about your interest. So if you are bearing, I mean, a huge amount of interest, and you need to think that you may, it is a time to repay your loan. Maybe it is eating up your most of the profit, your interest expense. So that means anyhow you need to, meet up at least a part of your loan. You need to repay. Okay, and for that, how you are going to fund the repayment of loan, that is the next decision. Where from the, so as I said that all the decision first comes is what is the requirement of the cash, and then comes the source of that fund. So what is the requirement of the fund? Is it the operating requirement? Is it in the investment front? You need to think that where is the requirement, and then you can think that where from the I will get the money. I should take the money. Where from? Which fund? Equity or debt or what? What is the situation of my business currently? Okay. So net income, as I said, it is revenues, expenses plus gains and losses. And retained earnings, we know that beginning retained earnings plus net income minus dividend. So revenues and gains ultimately increase retained earnings, and expenses losses decreases retained earnings. So what we have studied so far, that what is the objective of the financial statement, and few principles: conservatism principle, matching principle, revenue recognition, that the accounting few principles we have discussed that affects the reporting, right? And in income statement, preparing an income statement from the transaction history, how to prepare that we have discussed, how to present it, the breakups, and the information in components of income. So what kind of information it conveys to the investors, that we have found. Okay. So what is the difference between the cash flow versus actual accounting, and how this, it can be better understood if we discuss a bit about the stock price. So what is stock price? See, present value of the expected future cash flows. Now, why suddenly this discussion I have started, because this is a brief discussion what I will do. Maybe many of times you may have a question that when I'm going to value a company, where from that value actually is coming, right? So far when I am discussing that this is the trend, this is the performance trend of the company, what is coming into your mind? Where from the value is generated? It should be generated from the profit you are making, right? So what is the source of the value? Now, I do not remember whether I have discussed in the class. So when we talk about a good business model, so there are three things that actually is the driver of the value. First is, what is the source of the value? Firstly, where from the value comes? If the business, when we say that I'm doing a business, that means what is your target? What is your objective? Tell me. Now this is what I want to discuss with you. So when you are doing a business, what is the purpose of that business? What is your purpose? What is your goal? What you want to get by doing the business? Who wants to say? Anyone. It is not that I am asking any right or wrong answer. We will discuss just.
Ma'am, create value.
Yeah. So create value means, create value for whom?
For the customers employees and investors.
Earn profits.
So is it a voluntary service are you wanting to do?
No, ma'am.
Creating some value for your customers, employees,
And that's how you
and you
generate
will be
profit
happy?
for ultimately.
And for shareholders particularly.
For shareholders, right? So there are, I mean, many debates, many, researchers on who actually the value is going to, is going to get, who is going to get the value of the business, who should be, where should the value go? Okay, so the value is for everyone, all stakeholders, the community. That is fine. But any business, the ultimate goal is you cannot do. Say, for example, if you want to do something for society, and you think that okay, I will do it now, and you are not going to develop yourself, so that means you are restricting yourself, right? So if you develop yourself and then ultimately after many days, if you think that I have reached such a position that now I can deliver to others also, I can do something for the society. So similarly in a business, if you yourself, if you cannot create the value for the business, then you cannot deliver it, you cannot distribute it among others, right? Even if for giving salaries to your employees, even if for satisfying your customers, you need to, first of all, you need to create the value, otherwise how you are going to give it, right? So when you are saying that creating value for the shareholder, so you means what? Business is a separate entity, right? So you means the owner, who is the founder of the business. So founder of the business is creating value, okay, for the shareholder. Shareholders means the founder, also the shareholder, whoever is infusing money into the business, he is the shareholder. So creating value to the shareholder. So where from that value comes? What is that value? What do I mean by that value? What I will get?
I'm increasing the
Yes.
profitability.
Okay, so this is one driver of value, right? Increasing the profitability. That is one driver of the value. So where from the profit comes? Say, what is the starting point? What is the starting point? Where from the profit will come? You have started a business and the profit will come automatically, or
From
what you need to
sales or
do?
revenue.
Sales, revenue. So for a good business model, there are three components, basic three components. The basic driver is the revenue, right? So you need to sell something, you need to deliver some goods or services to your customers, where from the revenue you will generate. So that is the first driver of value. There are three components. First is the revenue. And then from revenue, but if you have, even if you have revenue, you are not creating the value, right? Maybe you have so much cost to incur that it is eating up all your revenue. So ultimately what you are giving, you are making a loss only. So any value is created? Not. So revenue is the first driver, but it is not sufficient enough. So next comes what? That you have to generate profit. Profit is the next driver. Okay, so you have to generate profits. This is the second component of the good business model. So your first target is to revenue generation. The second target is not only revenue, but you need to start making profit, which you cannot do in the initial, a few months of your business. But later on, gradually, you need to start making profit. Otherwise, continuously your cost will eat up the revenue, and ultimately we cannot create a long-term value for your shareholders. So next comes the profit. Okay, what next? So is it enough? Is it enough to have profit, or you think
And the
there's something
profits
else?
should be recurring, continuous profits. Like
Yeah, continuous profit, true. And then is it enough to have only continuous profit? So there only your answer lies. Okay, Divyam. So now if we
Unsustainable
have, so
profit.
just look at the slide. It is, what is the heading of the slide? Cash
cash flow.
versus accrual accounting, right? So then if profit is enough, so then what is the importance of cash? So the next important thing and the most important thing is cash flow. Okay, so first is revenue, second is profit, and the third is cash flow, which is the most important component of a good business model. So many times actually investors miss out. What they do, they only, especially in recent times, we'll see that for the startups and for others, there are continuous making loss, but still they are getting huge investments. Okay, so this revenue, while they are looking for more and more revenue by targeting more and more customers, but actually they are bearing the cost, they are overlooking, and investors are also overlooking. Why? Only they are looking that at that the future potential of the business. So depending on future how the company is going to do, they are overlooking the present performance. So that's why it is a kind of, it is called a bubble, because you do not know whether you are able to uh, that future potential is actually going to happen. And if it does not happen, then everything will become a bubble, and your value will go down, right? The company's value will go down because it is only on anticipation this valuation has been made. So this revenue from profit and then cash flow. So if you see that cash flow is the most important thing, because without that, if the business is in trouble, no other component can help you to generate the value. So it is the hard cash. So it is called the oxygen, without which your business cannot sustain. And during the COVID period, when there was many of the business, especially the small businesses, which were in huge trouble, that is only because of their low cash flow, the low liquidity. Okay, so low level of liquidity. So liquidity is even more important for the small business than profitability. So revenue is important, but it is not, till the time it is able to generate profit. And profit is important till the time you can convert it into cash. If you cannot convert it into cash, and also by now you know that how much we can change the profit figures by applying our discretions, by managing the earnings. There are huge scopes of managing earnings. So we can change, we can show the profit in a different way. So what is the other statement, other financial statement you need to see and analyze carefully? That is a cash flow statement. What is the status of the cash? Is it only the company is telling something about profit? But that thing, even if you can have a chance to manipulate the profit numbers, you do not have any chance to manipulate the cash figure. Okay. So it is not at all possible. Cash, if it is there, you can see it. If it is not there, you cannot see it. So you cannot change the number, because cash inflow, if it happens, you need to record. If the cash outflow is happening, you need to record. There is no question of, just by different recording, you can change the figures. Okay. So valuation, actually the good valuation, it comes from the present value of expected future cash flows. So cash flow is very important. Okay, just a minute, just hold on. Okay, so present value of expected, here see, here it is not written that expected future earnings or expected future profits. It is expected future cash flows. Now changes in it, when we talk about the valuation, there are different methods of the valuation. So present value of expected future cash flow is your discounted cash flow valuation. Okay. Now changes in stock prices is changes in expectations about the future cash flows. So it is, the emphasis is more on cash flows. Now when we do the projections of cash flows, we cannot do it the current cash flow you have, and you put some growth rate on the cash flow and you get the next year's cash flow. We cannot do it that way. We need to start from, we need to do that projections based on our revenue only. Okay, because the growth happens to revenue, growth does not happen to cash flow. So we need to put the growth rate on our revenue only. So how the revenue is expected to grow over the time, then how the associated cost may also grow, And then what is the cash flow? We have not yet done the cash flow calculation. We will do it. So how the cash flow is going to grow over the time. So from that, we generate the value of the business. So stock price talks about more talks about cash flow, and accrual accounting it more talks about the your profit. Okay. So which cash flows are important? Future cash flows are important to get the value of your business. When compared to current cash flows, current earnings more highly associated with future cash flows. Why? Because from, as I say, that current earnings means current revenue. So from current revenue only we get the revenue growth, and from there only we get the future cash flows. So when compared to cash flows, earnings have a stronger association with stock prices. Why this is so? Because without that you cannot get the cash flows. So, as I am saying that when I will do the cash flows cash flow class, it will be more clear to you. Now just remember that stock price talks about the future performance and earnings talks about the past performance. So you understood that? There are two kinds of performance. One is operating performance, one is market performance. Market performance means stock performance, which counts, which considers the future potential, future performance, expectations about future performance. And earnings, it talks about the historical performance, what actually happened. So when we decide how to incentivize the management, the top management, it is not linked to stock prices alone. So how we can incentivize the management which is aligned with stock price? Any idea? What kind of incentive is aligned with stock price? What is that?
Employee stock options.
What is that? Just explain.
ESOPs are part of preferred equity, and they are vested over a period of 3 to 4 years.
Mm-hmm.
And that's much more. It's like it's having preferred share for the company. It's like having preferred share for the company. And in case of companies,
What the management is getting?
companies often go for a ESOP buyback, or when the IPO happens, you make a lot of money out of the ESOPs. That's why a lot.
How that is my question is, I mean, how you are getting ESOP, right? You are getting salary over and above, you are getting ESOP as a top management.
Yes,
So
ma'am.
what exactly you are getting? Where from you will get the money? You are saying that you can
Ma'am, ESOPs are basically just like stocks. Like they are not public companies right now. But in case of, let's say, a private company, let's say I'm giving you ESOPs worth $30,000, and they're vested over a period of 2 years. So you can exercise them, or you can sell it back to the company and get 30,000 or whatever the current value of.
Yes. So that means it depends on the price of the market price of the company. You are not exercising it right now.
It depends on the valuation of the firm.
But what is the purpose behind giving the ESOP? That is, as a management, if you can grow your company, then automatically the price of the company will go up. So your valuation of the stock will go up. And when you are going to exercise that options, you can get the money back, right? So you can have a highly valued shares when the stock price go up. So your incentive will always to work for your company so that the valuation of the company goes up, and when you are going to exercise, you get the money, you get the value. Okay, so to align the management's interest with the company's interest, because company needs to grow and the management needs to help to grow it to the right direction. So if you cannot align management's interest with company's interest, you are only giving salary, so he will not look for the future growth of the company. So maybe there is a huge risk in making some decision in investing into some R&D project. But if you are not aligning management's interest with company's interest, the management may think that so it is a very risky option. I mean, I'm not going, I'm going to skip it. So let me, I mean, I am not going to think about future growth of the company because it is a risky proposition. So let me look at the present only. Let me lay off some of my employees, and then, I mean, I can save some cost, my profit will show good. So it is a short-term orientation of the management. But the long-term orientation is the company, by spending on that R&D, maybe it is risky, but still the value of the company will go up because the market will feel that yes, the company is investing in some good project and maybe it is going to give a very good return in future, and the value of the share will go up. And your, as a top management, your return is also going to be high. Why? Because you are also getting ESOP, you are also aligned with the value of the company, your interest. Okay, so that's why he will work for that risky proposition. He is not going to avoid that. So that's why these incentives are to align the incentive, to align the interest of both the company and the management. These ESOPs, I mean, are used. Okay, but it is not only linked to stock prices. Why? Because stock prices are affected by economic factors that are outside of a manager's control. For example, macroeconomic factors, political factors. Okay, so there may be a, I mean, rise in oil price. There may be a war that has broken out. There may be a suddenly, I mean, the political unrest, whatever it may be. So that has impact on the your valuation, which is beyond the control of the management. But if you only, I mean, give the incentive on the basis of that stock price only, then maybe some factors which is beyond the control of management, for that only the manager is going to gain or the manager is going to lose. So that is not right, right? So consequently, stock prices may be a poor indicator of managerial performance. So only by looking at the years, the price is very, I mean, going high, that means the management is doing good, it may not be. Or price is going low, the management is doing bad, that may not be, because there may be other factors also. So now if we combine both the accounting earnings and the stock prices, that is the future and the history, the historical performance and the future expected performance, if we can combine these two and then we incentivize the management, it mitigates the problem. The second reason for using accounting earnings also is, I mean, to give the incentive to the management also based on the accounting earnings, that is the historical performance. What is the reason? Expected versus delivered performance. So firm X hires manager Y on December 31st, 2015. Now stock price of X jumps by 10%. Why? Because market's expectations regarding the company's future performance improve. So you will find that many a times whenever there is a, I mean, new investors invest into the business, new acquisition the company is making, or the new CEO is joining the business, those news, I mean, time to time we get it in the, I mean, newspapers, in the media. So that actually creates, I mean, either a jump in the stock price, or it reduces the stock price sometimes. It has some impact. So whenever a CEO join, new CEO, I mean, we know that a very reputed CEO or reputed board member, they join, the feeling of the market is it is now in the right hand and it will help the company to grow. So the price of the X jumps. Now, in the next year, we have seen that the accounting earnings also increases by 10%. Why? Because manager Y's action produce an actual improvement in the financial performance. And stock prices anticipated this improvement at the time of the earnings announcement. So what happened after a year? Time the CEO joined the company, then the stock prices go up. Anticipation was that that he will make the company perform better, and actually it happened also after 1 year. Now, by combining stock prices and earnings to reward managers, a firm can reward a manager for his or her strategic planning and operational execution. But of course, stock prices do not reflect the delivered performance of the manager as well. But if payment is on the basis of expected performance, then what do you do if the manager shirks subsequently? That is a moral hazard problem. So earnings provide a straightforward measure of delivered performance. So see, now only you are giving the salary on the basis of the future anticipation of that value of the stock. And then there is no link with the current performance. And then at the end of 2016, you have seen that, I mean, what you have anticipated the company will perform better, actually the company's performance went down. Okay, so that means what? That means the manager did not work he was supposed to do. But you have already incentivized him based on the stock price only. So that means to avoid that moral hazard problem, you are on one hand you are incentivizing him to align his interest with business's interest. At the same time, you need to also see that what is the actual performance, actually how this management is performing for the improvement of the business. Okay, so these two bases, both the market value and the operating performance, both are actually important. One talks about future, one talks about the past. So when you are also going to analyze the future, the basis for determining the value of future is past. As I said, that current earnings is more associated with future cash flows. Okay, so wherever you are getting the future cash flow idea, that is starting from your current revenue, current profit. But you need to take into account both your expectation and your current happenings. You are going to analyze a company's financial statement, or when we do the ratio analysis class, you will find that it is on one hand it talks about all the operating ratios, efficiency ratios, your profitability ratios, liquidity ratios, everything, the current status of the company. Along with that, what are the price earnings ratios, what are the market ratios that you need to consider, the based on, and how you are going to compare among different companies in the same industry, or how you are going to compare it with the same, companies different years, among the different years of the same company, and how it is going to give you a picture of the company is over the time, how it is doing. Okay, so both the market performance and operating performances are important. Okay, this is a I think this we have discussed a lot about these transactions. So this is for a brief presentation of the how to record the accrual, how we record in an accrual system of accounting. So when the when there's a cash transaction, how we record it. When there is a non-cash transaction, how we record it. Okay, so in case of if it is a cash transaction, so just when the cash we receive and the cash outflow happens, we record it in the current year. And if it is a cash revenue and cash expense, and in accrual system of accounting also we follow the same. We record the revenue in the current year, and we record the expense also in the current year, because all the revenue is in cash and all the expense is in cash. But if there are accruals, if it is not totally in cash, if the cash we have received earlier, goods we have delivered later, if the goods we have services we have received earlier, cash we are paying later. Similarly, if cash we are receiving first, and goods we are delivering later, and cash we are receiving later and goods we are delivering before. So what are the effects on different periods? What is the effect on the current period? What is the effect on the previous period? What is the effect on the subsequent period? So those are the things that we have, that is briefly again presented here, this slide and the next slide. So I think we have explained these things. I mean, we have discussed many transactions. The first one is the cash transaction. The second one is cash received before earnings. The example is say um, I have received cash before and I am going to deliver it later. So it is the advance payment made by others to you. Okay. So you have received the payment earlier and you are going to deliver it later on. So advance payment made to you. Cash received. The next is cash received after the earnings, after earning the revenue. So cash received. First you delivered and then this is kind of receivable. So you have delivered the goods but you are getting the cash later on. So how it is going to affect your accounting equation in the current period and what will be the effect on the next period, the subsequent period. Okay. And here the payment in the context of the payment, when there is a cash expense, so how we record it, and when the cash paid before the expense was made, that means advance payment has been made. So where it goes in the prior period and in the current period, and if the cash is paid after the expenses made, that means you have made the expenses, say for example, but the cash you have not yet paid. You have recognized the, for example, outstanding wages. What we are discussing, I am supposed to pay this current year, but actually I am going to pay it next year. So it is outstanding wages. So this kind of expenses, where it comes in current period, what is the treatment? In subsequent period, what is the treatment? So these things are presented in a short form. You read it on your own. Okay. I'm going to share this slide also. I'm going to share the assignment. You remember I have given you the assignment.
Yes, ma'am.
So I am going to share the answer also for that assignment so that you can check whether you have done it right or wrong. And if you have any doubt, you can ask me in the next class. Okay, I'm going to share it today with these slides only. And I am now, just a minute. So you please see, look at the, I mean, go to your files. I have uploaded one case. Are you able to see it?
Yes, ma'am, we can see
I've
it.
just uploaded the file, okay?
Yes, ma'am.
So you just open the case. Read the first page only. Just let me know once you have completed the reading.
Ma'am, can we leave because we have a test at 10?
Yes.
Ma'am, can we leave because we have a test at 10?
Yeah, you can leave. Then just a minute. Let me take the let me download the attendance sheet. So okay, I will do one thing. You just read the first page, okay? And tomorrow's class, I will discuss this case along with you. You will only solve it. So the first page, at least you solve and you share.
Okay, ma'am.
Okay. I mean, you didn't. Each and everyone need not to share. Just one member from the group. The first page, the first page of the case, you just prepare and share it with me. Today I will discuss, and the rest of the case also I will discuss in the class. So there is a half yearly statement you need to make. The half yearly financial statement for from the first page information. I have downloaded. Who wants to leave, please leave. I'm just telling others that the half yearly statement you please prepare and share it, and tomorrow we will discuss the rest. I'm going to give you the email ID where you need to share the first the half yearly statement. Okay, just at least try.
Ma'am, what do we have to do in this after reading the first page?
Do the, I mean, half yearly statement, financial statement.
Which statement?
Both balance sheet and income statement.
Okay, ma'am.
Whatever idea you have and you got from the case, try to just make an attempt. Okay, we will discuss tomorrow. I'm going to share that which email ID you are going to send. Okay.